So a very warm welcome to our Business Booster webinar on profit and loss. I'm really excited once again to be joined by Tony Rudd, our Finance Director. I'm Daniela Norman, our Education Operations Manager. Our aim today is to, again, try and give you the key takeaways in having a successful profit and loss. And we appreciate that there's going to be lots of different people from different types of businesses joining us today and people with different levels of experience. So although we're going to do our very best to give you the most tangible tips that you can apply to as many of your different environments as possible. So Tony, just like we did last time, maybe we start at the beginning. For those that joined us last week and saw our cash flow session, how is profit and loss different? Why am I doing profit and loss alongside my cash flow?
So profit and loss really is the overall profitability of the business. Where the cash flow that we talked about focused really on the timings of when things are happening. The profit and loss statement, or P&L, or profitability statement, all these things it's called, focuses more on the overall profitability, smoothing all that out, so you've got a better view ongoing of is my business making profit.
Okay, so for example, last time we talked about cash flow, and the example we gave was if I am a business and I've got a very cash-rich month in December because I'm probably making a lot of revenue in product sales, treatment sales, vouchers, that's when the revenue's coming in. So my December sales in is going to look quite strong in comparison to other months, but my commission payment is probably going to be higher in January than in other months because I'm now paying the team's revenue that they generated. So I'm doing that differently. So how would that look in profit and loss?
So it's a good example. So commissions, so you'd agree to the staff earning that in December. In a P&L, you would take that cost into your December, whereas in the cash flow, you wouldn't take that until January when you physically paid it. The other really good example, which I think is really clear on this one, is if you buy some equipment for your business, in the P&L statement, you don't see that as a one big cost hit to your numbers. So, example, you spend £3,000 in March. You don't see that in March as a £3,000 cost. You'll see it in your cash flow as a £3,000 cost, but in your P&L, you'll then smooth this out for however long you're going to use that piece of equipment. So, if it's going to be used over 2 years, you would take 24 payments of 24 amounts of that 3,000, smooth that out. So that's the big difference.
So should we have a look at an example?
Yep.
Okay, so I'm going to just share our screen with everybody so that you can see what we are looking at here. So there we go. Sorry about that little bit of music intro. Oh, and back one. There you go. Okay, so let's just have a look at the P&L that we've got here.
So hopefully this gives, so we talked about the cash flow last time, and in the blue heading at the bottom, you can see the cash flow example that I populated with some numbers.
So that's over here.
And at the top, we've got the P&L example. And I've used, if you like, the same numbers to populate the P&L and the cash flow so we can see what some of these differences are. Now, we just talked about the commission scenario. So if you look at the December column on this sheet and you look at the salaries, benefits, commissions line, in the P&L, you can see an amount of 3,917. Now that essentially includes this extra 1,000 for commission that we're agreeing we're going to pay our staff. However, we don't pay that until January. So what you see in the cash flow at the bottom is that we see the 3,917 in the cash flow, but the corresponding January for the P&L, you won't see that. So that's one of the timing differences.
Of course, yeah.
The biggest difference that we just talked about, I think, really obvious one is that equipment purchase. So if you look at the bottom in the cash flow in March here, so here we go, I put the example in, we're spending 3,600 on some equipment. In your cash flow, that will all happen in March because you've got to buy it. In your P&L, you won't take that cost in March because we're now going to smooth this out. So my example here, I think we're going to use that equipment over 3 years. That's what we call its useful life in accounting speak. So we're going to have 36 amounts of £100 where you take the cost into your P&L.
Can I just ask a question, because I think equipment's quite a big part of what we're investing in our industry. If I'm expecting to use that indefinitely, do I adjust how I'm putting that in, or do I estimate a usable time?
There are very few assets actually, in accounting terms, very few assets that you would keep going indefinitely. Okay. Land is one of those because nothing ever happens to land, but everything else mostly has some kind of finite life share, so it comes down. Now, the principle that we're talking about here, and why this is important, is something called the matching principle in the P&L, where wherever you earn your revenue, you must take the associated costs to that revenue in. So when you sell something, clearly you've got the cost of the product that you've sold, or the service or the treatment you've given will have product costs related to that. If you're then operating out of a leased building, there's a share of that lease. If you're operating out of somewhere you bought, there's a share of the mortgage payment. Your utilities, every day you're using a piece of this. So what you try and do in the P&L is bring in the equivalent share of all these costs into that month. So you can really see, am I making a profit or not?
So you talk about matching, and I think that's quite a useful tip in terms of me making sure I'm doing the two different spreadsheets correctly. So my cash flow is all about timing and the actual date the money is coming in or going out, and my profit and loss is about matching that spend and that revenue together. And I think you've got a good example here of rent, where in our cash flow we can see that I'm paying rent quarterly, just over £2,000 every quarter. But here in the profit and loss, I've averaged it out because I'm benefiting, I guess, from that space every day. So it's averaged out, but my cash flow is different. Excellent.
So you can look at, by doing this, you can look at your P&L either on a monthly basis to look at the profitability, or you can look at it on a quarterly or an annual basis to work out where are my costs.
Okay, perfect. Okay, so I think that gives us a really good idea of what we're looking at. So,
Sorry, Dan, one thought on this is the terminology on the P&L. I often get carried away on this because I just assume that everybody knows the financial terminology here, but actually some of these lines on the P&L are called different things, but are actually the same thing. So it's worth highlighting that on the sales line at the top, you might hear the word sales, you might hear the word net sales, you could hear the word turnover, you could hear the word revenue. It all means exactly the same thing. There is no difference. It is just sales.
Okay.
Then profit and gross profit and net profit, worth a quick word on that. So gross profit is the profit you make after giving a treatment or selling a product without any of the other sort of cost base in there. It's anything directly related to giving that treatment or selling that product. That would be your gross profit. Then when you take in all of your other things, which is just the cost of the premises of the business, your utilities, your salaries, all those things that come in, that's when you'd get down to your net profit. So you can see on here your gross profit right at the top. You got your sales, you've sold that treatment or your product, you've got your costs of doing that, your product cost, everything else then falls into the next bucket before you get to net profit.
Right. I think that's great because terminology can sometimes trip us up and make it a bit of overwhelming to complete in the beginning. Okay. So I'm going to just end that screen share and bring us back to camera. Okay, excellent. So Tony, why is it important to do this profit and loss for my business? How is it going to help me in terms of understanding my business?
I mean, I guess there's two main drivers of having a P&L, a profit and loss statement. One is there's a regulatory requirement in many cases to submit this, whether it's for tax purposes, whether it's for filing with Companies House or the equivalent in Ireland. So there's a regulatory piece, but there's also, for me, the real reason is you want to understand your business. You want to understand what costs and revenue do I have now? What are the trends? Where's it going? So you can really start looking at what is it that I might need to change to improve that.
Okay, so basically how things are building up and building a picture for my business.
Exactly.
So what am I looking at when I do that? What should my ratios be? How do I understand that for my business?
Well, every type of business is going to have really a different sort of cut of those ratios in terms of where should these costs be. I prepared what we can show in just a minute, a slide that sort of gives a rough indication of what these things should be. So rent and salaries is probably quite a good example because they'll take up the bulk of your costs of that business. In the scenario that I've used here, it's probably around 50% of your costs would be an optimal place to get to. I'm very conscious that if you've just started your business, it's going to be a bigger share of that. And as it grows, that's going to decrease. Right. But it's a good indication that if you're an established business, you kind of want that to be half of your costs.
Okay. So should we share that with everybody? So let's just... Okay, so this is your optimal scenario that we're talking about. And just talk us through, so you've got about 50% there for salaries and rent. What else am I looking at that builds up my business?
So the big blue chunk on there, if you like, is your cost of sales. That's another big piece, and that's your product cost in terms of whether it's the products used in the professional treatments or whether it's the product for the retail sales. Anything linked to giving that treatment or selling that product will be in your product costs there. That's often a big chunk of the business cost as well. So then we talked about the sort of the pinkish colour box there, the salaries and the rent, the sort of violet colour. Those two together are usually around what you don't really want it any more than 50% of your business. Now, that will fluctuate depending on how established you are. Then you have the next block, that's your utilities, roughly somewhere under 10% is probably a good place to be. Then you need to reserve a bit of space for your advertising and equipment. Clearly, you've got to buy other equipment to keep your business going, so you need to have a share of costs in there. And really important, advertising. Maybe you can't promote your business, you're not going to get those new customers in, so you've got to leave some costs for that. The yellow chunk at the end then, that 15%, that would be an ideal amount of profit to have. I mean, many businesses make probably somewhere in the region between 5% and maybe 20%, 25%. That's probably the range of what you'll see. So 15% sort of sits in the middle of that.
Okay. And I suppose, like you're saying, it's got to be specific to my business, because if I'm a home-based business, then my rent is going to be a much smaller portion of that. But perhaps my advertising is going to go up because I don't have passing trade. So perhaps I'm doing more for paid advertising on social or local community. Is there a variance for, having an online business? Do we do something completely different there?
Online can be just even more profitable, essentially, because you don't carry some of those fixed costs that others do. Sure. So that's always a very profitable channel.
Okay. And should I be worried if I'm seeing that my salaries and rent is a much bigger section and I am a few years into my business?
It's something to look at, and I think you then need to look at, am I really getting the optimal utilization out of my space, if you like? So am I running it for occupancy or not? And look at that, because it might just be that for the size of the place you've got, it's probably the right sort of cost, but you're just not maximizing what revenue you get in. Okay. And by getting more revenue in, that percentage of cost will drop.
Okay. So Tony, we only have limited time. So if I was to take away one key concept to managing my profit and loss very well, what would that be?
So the key thing for me is, and this flows from understanding the blocks of costs in your P&L. In finance, we talk about something called fixed and variable costs, or it's often referred to break-even analysis. Okay. And this essentially takes all of the fixed costs that can't be avoided. So rent, you always have to pay that. The salaries, you always pay that. The utilities, you always pay that. You take all these fixed costs and you look at that as a total base, and you might go, well, that's going to cost me £4,000 a month, as an example. Therefore, you now know that you need to make £4,000 worth of gross profit to cover that, so you actually break even.
Right.
And then you can break that down into, so what would 4,000 equate to? How many treatments is that? How many product sales is that? So it's a useful piece of analysis to work out what is that right level of sales I should be aiming at least break even. And anything more you do above that clearly is then into a profitable place.
Okay. And I think you've got an example for us.
Got an example that we can look at really just to help with the numbers and how that comes together. So we can see up here, I put this together, and you can do this under different time periods, whatever's helpful for you, but I put it into a month, into a quarter, and into a year. So in this scenario here, if we look at the month, we can see that roughly it's that £4,000, it's £3,800 of total fixed costs we've got. So then we go, how much profit do I need to make to cover that? In my scenario one there, I've got gross profit per treatment, which includes also the sale of one product. So that would net us around £49, £50. That would mean each month you'd have to do 78 of these to cover your cost base. Looking at the same thing there, gross profit per treatment without a product sale, clearly it's now going to be a lower profit coming in. So now it looks like we've got to do about 132 treatments. So each business is going to be different, but you'll know roughly how many product sales you might average per treatment you give. But you can run these scenarios then to really work out, where should I be targeting? What should I do? This analysis is also very good because you can do the what if type thing. So you can say, okay, so I've got this premises now that I'm maxing out. I've got this number of staff. If I want to increase any of those, so let's say take on a new member of staff or increase my premises, and that's going to cost me another, let's say 1,500 a month. You can now use this analysis to work out, okay, so if I take this person in, how many more treatments would I need to do to make that successful?
Okay. And I think this is really great and very useful for anybody who wants to expand or needs to analyze, that breakdown. So Tony, just talk us through, obviously you've based the revenue generated by a treatment, sort of an average of what we're seeing charged for treatments across the country.
Yes.
And what we know it costs to deliver a 60-minute treatment. So that's sort of how you've worked out that £49, £50 gross profit per treatment, and then product on top of that.
Exactly. I mean, you can obviously clearly tailor that to whatever your own individual scenario is, but I just took a scenario that said, look, I'm just going to average the average cost of my treatments to the customer is £35. That might cost me £6 in the professional product to do that treatment. Then if I make a product sale and that's netting me about £20 worth of profit, that's how I get to my 49. But clearly, if you do more 60-minute treatments that take a bit more in revenue, but maybe might be a little bit more cost behind that, then you can run that under the different scenarios.
Okay.
You could also go, I mean, I've just kept this very top level. I mean, in an ideal world, you'd probably split that between how many, say, Pro Skin 60s might I do, how many 30s, how many Skin Solvers, and you'd do the same scenario breaking down to your different treatments that you know that you might run.
And I think you've touched on this already, but if I want to improve my profitability, I'm going to use this tool. But we can see that, it's looking at my room capacity. Retail sales make a big difference, because if I'm not retailing products, I've got to do 132 treatments. Whereas if I'm just retailing one product to each person, then I only need to do the 78 treatments a month. And then I just go and work that out based on the number of hours I'm open, the treatment rooms I have, the staff I have, etc. And I can see. Yes,
exactly. I mean, yeah, if you can get those product sales obviously into the treatments, that's a massive benefit. Understand it's not always the kind of the natural or the comfortable place for the skin therapist to go in there and sell the products on top, but actually it's a really good place. You've just done 30 minutes or 60 minutes with the customer. And from my own personal experience there, I mean, I've had a few treatments. If you've had a really good treatment, you almost feel like you want to buy something because you've really had that good experience. So, I mean, if they can tap into that, then that's clearly going to help.
I think that's so important, because sometimes we forget to think about it from the customer's point of view. And I certainly know if I go somewhere, I've had a great experience, I want you to recommend something for me to replicate that at home. So I think sometimes the skin therapist can feel a bit anxious about the feeling that they might create when they're retailing, but actually it's about making sure someone maintains those results ongoing. I think if anyone's really struggling with boosting their retail, make use of the Dermalogica curriculum, come on the product knowledge, Dermalogica DNA, discover top sellers, just to refresh yourself. We've got happy retailing, which ensures that you're driving your revenue by being led by the customer. So it again removes that sense of I'm pressurizing you into a sale, where actually you're using the customer to lead you through that process. So lots of helpful tools there. So I'll stop sharing the screen here. And Tony, then is there anything else besides looking at my room utilization, considering my retail, that I can do to help boost my profits or reduce my costs? Is it just doing this process?
I think once you've got the view of the pie chart we had a minute ago, when you've got that out, when you can see where are my costs being spent, you can look at that over time as well, and you can work out what feels like it's the right balance for you or not, because then you're just focusing and say, look, if my utilities are looking like they're 20% of this, it's probably worth just doing a piece of work to then look at, are there alternatives that are cheaper? Where are the options? So the first thing for us in finance is always get a clear data-driven view of what am I paying now, and what might be the benchmark out there, so I can go and do something about it. The more we measure stuff, the more you've got a chance to work out what is it you can improve on.
Yeah. And it's just doing the start, because then it's not so overwhelming for me to decide what I need to do for my business, because I've actually just got the data in front of me and I can make those decisions about where I need to make those improvements. Excellent. Well, I can't believe it, but that is our 20 minutes. So what we wanted to do again is just stay online to answer any questions you might have. So I'm going to hand my keyboard over to Jess, who's behind the scenes, has a better view of the screen, and can have a look at the questions section. So as I mentioned, you've got your resources available to you, and you'll see that we have created a template for you to download with all of these examples, but left blank for you to fill in for your own business. And then there's also a PDF version of the completed slides that we've been sharing with you today for you. But hopefully you found that really useful in terms of going away and putting something tangible in place for your business, and making sure that you can be more profitable, understand your cash flow, and get your business on track for a really strong and successful 2019. Don't forget we have, oh, sorry.
So I can see already there's a good question come up there, actually. Okay. It's about turnover and VAT, which I didn't cover, so that is a good one.
Do you want me to just read it out?
Sure.
Yeah, so
the pie chart, is that what percentage your cost is of our overall turnover? Do you do that on turnover excluding VAT, or is it percentage of the total costs? Would you like me to reshare the pie chart as well?
Yeah, that's fine. So, yeah, that's a really good question because the pie chart is based on turnover, as you say, and it's also based on turnover excluding VAT, because the VAT element is not something that you actually keep personally for your business. So that's something else that's just given straight back to the revenue, so they take that. So working out your cost, yes, take off the VAT. So whenever you publish turnover in a set of accounts or internally, you should always remove the VAT element, because it's about what portion of this is actually for me. The VAT bit, that's for the revenue services, they take that. So yeah, the cost percentage of this pie chart is based on turnover excluding VAT.
Okay. And one additional question, do self-employed accounts need to do the depreciation?
Not necessarily. When you do very small accounts, there's very abbreviated rules actually of what you need to publish. So actually they make it very easy for a sole trader to actually publish a set of very basic accounts. It's more for you to get that understanding yourself of, do I have the profitable business? And if you know that you're buying some equipment that's going to last you 5 years, you should really be thinking about that in terms of that cost is based per month, not the initial chunk of cost you're spending, but how you break that by 60 installments, if you like, over those 5 years. But it's much more helpful to think of your business sharing the cost that way.
So what I do need to do if I'm buying a £3,000 piece of equipment is I need to look at my cash flow to make sure I have the money to buy it outright, yes, or negotiate some kind of terms, I guess.
Yeah, and it helps you with the funding as well, because if you know you're buying some equipment and it is going to last you 5 years and you do need to go to finance that, well, now you can look at options of taking out separate finance, which is going to cover you for the 5 years for that piece of equipment. So you sort of match the expense of what you've got to the useful life of your asset. Okay. So you wouldn't want to take, for example, you want to take a loan over 5 years for a piece of equipment that's going to last you 1 year, but you want to try and keep those things lined up.
Right. Okay. Jess, anything else there?
Yeah, we've got another additional question. So I have just opened my own business as a sole trader. I am fully capable with my treatments. However, I feel that I need to improve on the business side of things. With regards to tax or VAT, do I need to approach a bookkeeper or accountant, or is this something I can manage myself?
It's probably better to start off going through an accountant or a bookkeeper. If you've never done it before, get the help of those guys so you get comfortable with it. It's something you can pick up and learn as you go through it, but just to make sure that you're not going to upset either the ROS or HMRC, get the help from an accountant to start with, and when you're comfortable, then you can start picking it up.
Should there be any conversation that I have with an accountant or bookkeeper about how our industry works? Is there anything that I should share with them? I don't know if you've learned anything having worked with us over the 9 months where you go, oh, this is useful for me to understand how your particular business works.
I mean, I guess finance cuts across so many different industries, and actually the standards of putting the accounts together are very similar in terms of the principles, no matter what the industry. There's always some things you've got to try and get in and understand, and I think probably some of the bits for me is more around the service, the treatment service side and the product side, and how that goes together in the accounts is often interesting to look at. There's nothing specific that I can really think about, because it is very generic in terms of how you put these accounts together, and it covers lots of the same principles.
Good, okay. Fabulous. I think we've had one more question come in.
Okay, at what stage would I need to approach an accountant? In the early days or closer to the January of when VAT is due?
Early days always better, because the accountant would probably want you to for you to share your receipts and your purchases and your revenue with them as early as possible. So they'll build up the books on either on a weekly or a monthly basis, so they're prepared. So when it comes to be able to submit your VAT return, they're not scrambling around last minute to work out where you are. They've got it all prepared. So earlier is better.
And if I wanted to, I'm planning to, let's say, open my own business, is there a preference of what I sit and do first, profit and loss or cash flow? They need to both go hand in hand.
I mean, they both sort of stem off the same sort of numbers. So if you've got any type of